Throughout Donald Trump's second term, observers have noted a striking pattern. Large volumes of trades appear in financial markets moments before the president makes public announcements that move those same markets. The timing is so tight, sometimes just minutes before a tweet, interview, or policy statement, that it has sparked allegations of insider trading, while others argue that sophisticated traders have simply become adept at anticipating Trump's moves. Below is a detailed look at the most prominent cases that have fueled the debate. One of the earliest and most striking examples came in the oil market during the early days of the U.S.-Israel conflict with Iran. 9 days into the fighting, Trump told CBS News in a phone interview that the war was very complete, pretty much. The interview was not made public until a reporter posted about it on X at 15:16 Eastern Time, 19:16 Greenwich Mean Time. Yet oil futures data show a massive surge in bets on falling oil prices at 18:29 Greenwich Mean Time, 47 minutes before the post went live. When the interview finally aired, oil prices plunged roughly 25%, netting millions for those who had positioned themselves ahead of the news. A similar sequence unfolded on March 23, when Trump posted on Truth Social that the United States had held very good and productive conversations with Tehran, hinting at a complete and total resolution to hostilities. The statement surprised diplomats and traders alike. Within minutes, U.S. benchmark oil prices dropped sharply. Market data revealed an unusually high volume of bets on a price decline just 14 minutes before the president's post. The same abnormal activity appeared in Brent crude contracts, prompting one oil analyst to describe the trades as abnormal, for sure. Beyond the Middle East, Trump's tariff policy produced another clear case. On April 2 of the previous year, he unveiled what he called Liberation Day, a sweeping set of tariffs on goods from virtually every country. Global stock markets reacted with a steep sell-off. A week later, Trump announced a 90-day pause on those tariffs for all nations except China. The S&P 500 responded with a 9.5% jump, one of its largest single-day gains since World War II. In the minutes leading up to the pause announcement, trading volume on an S&P 500-linked fund exploded from a few hundred contracts per minute to over 10,000 per minute. Some traders placed bets exceeding $2 million on a market rise, despite a week of consecutive losses, potentially earning close to $20 million if the move played out as expected. The pattern extended into the relatively new world of prediction markets. Blockchain-based platforms such as Polymarket and Kalshare allow users to wager on events ranging from weather outcomes to geopolitical developments. Trump's son, Donald Trump Jr., is an investor in Polymarket and serves on its advisory board, while also advising Kalshare. In December 2025, an account named Burdensome Mix placed $32,500 on a bet that Venezuelan President Nicolas Maduro would be out of office by the end of January 2026. When U.S. Special Forces seized Maduro the following day, the account won $436,000 before changing its username and ceasing activity. Further analysis by Bubble Maps revealed 6 accounts created on Polymarket in February, all wagering that a U.S. strike on Iran would occur by February 28. When Trump confirmed the strike in the early hours of that day, the 6 accounts collectively earned $1.2 million. 5 of those accounts have been inactive since, but the 6th continued to profit, earning $163,000 by correctly predicting a U.S.-Iran ceasefire announced on April 7. In response to growing concern, both Polymarket and Kalshare introduced new rules in March aimed at curbing insider trading. Prediction markets fall under the jurisdiction of the Commodity Futures Trading Commission, CFTC. Although the CFTC did not comment to the BBC, its chair told a congressional committee that the agency maintains a zero-tolerance stance toward fraud and insider trading. The White House also entered the fray. An internal email circulated to staff last month warned against using non-public information to place bets on prediction markets. A White House spokesman dismissed any suggestion of administration involvement as baseless and irresponsible reporting. Legally, insider trading has been prohibited for most Americans since the Securities Act of 1933, and the prohibition was extended to cover U.S. government officials in 2012. Yet, to date, no official has been prosecuted under that specific provision. Paul Uden, a professor of financial regulation law at Essex Business School, explains the difficulty. Authorities often cannot identify the original source of the leaked information, making prosecution unlikely even when trading patterns strongly suggest advance knowledge. Despite repeated requests, none of the U.S. financial regulators contacted by the BBC acknowledged the allegations. The SEC declined to comment on whether it had examined the claims, and the White House offered no response to inquiries about the unusual trading activity highlighted in the report. The cumulative evidence presents a dilemma. On one hand, the temporal proximity of massive trades to Trump's announcements is striking enough to suggest that some actors possessed non-public information. On the other hand, the president's unpredictable communication style has led some market participants to develop sophisticated models that anticipate his moves, blurring the line between legitimate foresight and illicit advantage. The lack of concrete proof of a leak source, combined with the jurisdictional complexities of monitoring both traditional exchanges and emerging prediction markets, has left regulators with limited tools to act. As the debate continues, the episodes serve as a stark reminder of how quickly information can travel in the digital age, and how difficult it remains to police the boundaries between public speech, private knowledge, and market behavior.